All right, Doug, good morning. I want to talk to you about inflation or deflation today. Now, these topics seem sort of esoteric, I think, to a lot of people, but they have real practical application for how you plan, how you kind of scenario out what might happen in the next, several months and years. But there are two arguments about one for inflation, or maybe many for one inflation versus deflation. I just want to, if you could lay out first, like what are those core arguments between the two, and what are the merits of each argument?
Hmm. Okay. Uh, should there be inflation or deflation? Well, should is a dangerous word. I mean, who's in control of what happens? Or actually, should anybody be in control of whether it's inflation or deflation? I would say we'd be better to live in a world that just had inflation and neither one. But that's not likely to be possible, at least constantly. So let's look at this. Inflation. Inflation, first of all, what it isn't the rises in prices. That's a consequence of inflation. Most people think that rises in prices at the butcher or baker is inflation. It's not. It's a consequence of inflation. So what is inflation? Inflation is an increase in the money supply. It's really just that simple. So nobody thought an awful lot about these things before the creation of central banks, which control the money supply. And, the guiding philosophy behind central banks, like the Federal Reserve in this country, the most important central bank in the world by far, or for that matter, the Central Bank of Argentina or the Central Bank of Zimbabwe, two of the craziest, most insane central banks in the world. They all are crazy. I don't care how many PhDs they have working for them. Those two institutions have lots of PhDs working for them too, incidentally. So what's this all about? What's the proper level of inflation? Right now, they're saying, well, we should have 2% inflation. That's what we're shooting for. Okay, I can understand why the powers that be want to have inflation. It drives up asset prices, makes people feel rich. People feel good when they feel rich. Okay, that's good. The whole world is deeply in debt right now, especially the US government. So they want inflation to take the pressure off having all that debt. Sounds like inflation's a pretty good thing. Actually, it's a horrible thing. It causes the business cycle. And we should actually have, the business cycle is something they never talk about on business shows anymore. But it is critically important. And maybe we should do something on that. I hate to get too esoteric in these things because then it starts to sound too much like an economics class. And nobody wants a lecture on economics.
No, people need to know how stuff works, though. I mean, it's just explaining the world that people are experiencing.
Yeah, but it's not really entertaining to talk about economics. It's really important to have these basic concepts down because they are not taught in colleges anymore. They really aren't. Or if they are, they're taught improperly with all kinds of false assumptions and false conclusions. I guess what we can do tomorrow or the next day or sometime soon is we can talk about the business cycle as well. And if people find that it's boring or irrelevant, well, you don't have to watch
No
that.
obligation to watch.
No, there's not. It's not like going to some college where if you don't go to class, the teacher gives you an F or something like that.
Exactly. We should definitely talk about it because I think people do need to understand it.
Well, they really should. They really should. Just so, yeah. Anyway.
So central bank causes the business cycle through managing the money supply and inflation in particular. Is that what you're saying?
That's exactly right. That is the root cause of the business cycle. And the business cycle, it would probably exist for other reasons we could talk about in the future, but it's basically a creature of inflation and the money supply and what central banks do. All right, so inflation is an increase in the money supply. So how's the money supply increased? in today's world with central banks? Well, what happens is when the government sells debt to the market, that's not necessarily inflationary. It's just somebody takes dollars that they've saved and they go to the government in exchange for the government bond, and the people get interest for it. Okay. The problem with inflation is when the bonds that the government sells are sold to its central bank. And how does that work? Government runs a $1 trillion deficit, well, like they are right now. So how is that financed? Well, in the past, it was financed by selling it to American savers. And that's why they used to say, hey, it's no problem. We owe it to ourselves, which was a lie to start with. It was phony rhetoric, because we don't owe it to ourselves. Some Americans owe it to some other Americans. Mm-hmm. And it's not a big we, okay? It's some people, borrowers and sellers. And okay, so it used to be we owed it to ourselves, the first lie. Then Americans stopped buying most of it. And the Europeans, the Chinese, the Japanese, they're all out of the market. They don't want any more paper. The guess is, nobody knows for sure, there's someplace in between 20 and 40 trillion dollars floating outside of the US. So they don't really need a lot more dollars at this point. Okay, so they're not buying the government's debt. So who's going to buy this debt when the government needs money to pay its employees and to do all the other wonderful things it does? Well, now it sells it to the Federal Reserve. What happens? They sell the million or the $1 trillion of debt to the Federal Reserve. What's the Federal Reserve do? It creates Federal Reserve notes, digital Federal Reserve notes, and it deposits those notes in exchange for the bond in the US government's account at a commercial bank, like Citibank or Wells Fargo or any of them, where the US government has an account. And that's how the US government gets its money. Mm-hmm. The Federal Reserve notes magically appear. And this is why when the Fed's balance sheet grows, it's a bad thing, because that's what's causing inflation. But it doesn't end there. So what happens to that, let's say that $1 billion that's now sitting in Citibank's coffers? Well, like any money that's deposited there, it has the ability and the right to lend it. But not just lend that money out and it's all gone, lend that $1 billion to GM. Okay, transaction, finished and done. That doesn't cause inflation. Second level of inflation is when it lends not just that money out, but on a fractional reserve basis, it can actually lend it out many times. How's that happen? So it lends the money to GM. So what's GM going to do? Well, it's going to spend the money, and that money comes back directly or indirectly through its suppliers that it buys things from. It goes back into Citibank and somebody else's accounts. Well, the money's reappeared again. So if you have a fractional reserve system, and now, I don't know what it is at the moment, but in recent years, it's typically been like 10%. If that money comes back, now you can lend out 90% of it. It comes back again. Now you can lend out 90% of that. So the banking system is an engine of inflation after the Federal Reserve is an engine of inflation.
Right. Most money that's actually created, though, is done through the banking system today, right?
Exactly, even more than the Fed. Mm-hmm. So the answer to the question is, what should be done? Question that Lenin asked in his famous book of that title, What Should Be Done? Well, in a free market world, there wouldn't be any central bank, any Federal Reserve, and there wouldn't be any fractional reserve lending by the banks. I mean, classically, the way it used to be done and should be done is that all the money that goes into a bank went into one of two types of accounts. This distinction has also been totally lost. There used to be demand deposits and time deposits. Demand deposits are where you put your money into the bank, your gold into the bank, and you pay the gold to store it for you. And you pay the gold for the right to write checks against it. I mean, it costs the bank money to store the gold, it costs money to write checks against it. So you paid a fee. That was called a demand deposit, where the bank, in effect, is acting like Allied Van and Storage for your furniture.
Oh,
They
okay.
can't lend it out. That would be criminal, it would be a fraud. Okay.
Right.
The other type of bank account, totally different business, is you put your money in the bank and they pay you, say, 3%, and they find somebody solid to lend it to for, say, 6%. They capture the 3% difference as compensate them for their risk, compensate them for, well, their profit. And in a sound economy, the banker, well, generally speaking, would not make long-term loans. Long-term loans are called bonds or notes. That's something you raise in the stock market. That's for investors, speculators. Generally speaking, banks would only lend money against their time deposits for their customers, short-term, a year or less, fully secured by something like the farmer's crop or, liquid assets or something that there was really no risk. And that's the way it used to be done. That was what the banking business was, those two types of deposits. Now, there's really no difference between checking accounts and savings accounts, demand and time deposits. Checking accounts and savings accounts was what they were then called. And, so now it's just a dog's breakfast of everything. And it's very inflationary. And today, banks just lend willy-nilly for years. And sometimes at fixed interest rates, which is crazy because they're borrowing short from people that put their money in their savings account, but they might lend it out for years. So if you borrow short and lend long, if people think, gee, this bank is making bad loans, or this bank is illiquid because its money's tied up for years, but everybody can get it out now, you used to have what was called a bank run, where as in everybody would run down to the bank at once to get their money out before it was all gone. In a sound banking system, if there was a bank run, well, you get your demand deposits because you're being paid to store it. And when you put your money in, it's for a fixed period of time. It's not instant withdrawal. You lend the bank. Well, it was like certificates of
CP.
deposit.
Yep.
So you can't break it before it's over, or you pay a big penalty for doing so. So the whole system is screwed up today.
So it's built on this. It seems to me it's built. The reason that the central banks seem to be so terrified of deflation, they seem to be terrified of it because my thinking is that it's because the banking system is built on the fractional reserve banking system is so leveraged that you could have these cascading consequences, where money can sort of vanish out of thin air so quickly. I mean, it could just like we talk about them printing out of thin air now, the money, they do that, but it could disappear so much faster because as some of the loans and some of the banking system proved to be insolvent, because they get that same leverage in the opposite direction, I guess, of that they get for the fractional reserve.
It works exactly in the opposite direction. So what happens when your bank lends $1 billion to some corporation that blows it and can't pay it back? What happened to that $1 billion? Well, it was actually created out of nothing, and poof, it dies and goes to money heaven. And then, just like there was $1 billion more created by the bank, now there's $1 billion less, which has all kinds of effects through the economy. But inflation is a very, very bad thing for all kinds of reasons. For one thing, just as we said earlier, it makes people feel that they're richer than they are as their assets go up in price. What happens when people are richer or feel richer than they really are? Well, they live high off the hog. And they consume more and they produce less. We'll talk about this in the business cycle. It's more relevant to that. But one thing that they do is they save less, but saving is capital. I mean, you got to produce more than you consume and save the difference. Don't think of it as money. Think of it as capital, which is better, because money is such a nebulous concept. It's just paper today. So who really cares about that? Sure, if it's just paper, you can grade it or whatever. Think of it as capital, which is real stuff that can be used to create more stuff. So anyway, if we lived in a free market system, instead of, which we don't today, incidentally, instead of prices going up every year, prices would actually go down every year. Let's say we use gold as money, historically the best money for all kinds of different reasons. So if the supply of gold in the world typically goes up by 1 to 1.5%, which is the rate at which it's been increasing for many years. If you have a gigantic gold discovery someplace, all kinds of gold you can have inflation in a gold-backed system if there's a huge gold discovery, or if some country finds somebody like the Aztecs or the Incas, conquers them, steals all their gold, and it floods into Europe. Yeah, you get an inflation, no question about it. But that's those things are pretty unusual, and in today's world, more unusual than they've ever been in the past. So normally, what happens is over time, prices go down, not go up. But that's a good thing. Deflation is a good thing because it rewards savers. People want to save more, consume less. That's how you get rich, by saving. I mean, it sounds
pretty simple. It's pretty simple.
Pretty simple. And interest rates would be naturally low if the value of money is going up every year, just as normally. When inflation is running 10%, I'm not going to lend you money for 0% unless the central bank legislates that, which in effect they're doing. I'm going to want 15% or 20% on my money. So it's wonderful. Mild, slow deflation, which is what you'd have in a normal economy. Yeah, you want to save things. I mean, look, kids don't save coins anymore. Kids used to save coins back in the days when they were made out of silver and copper. Pennies aren't even made out of copper anymore. People don't even, they're just washed on top with copper. They're going to abolish all the coins anyway. They're all going.
Yeah.
So I don't know, how's a kid saving his piggy bank if he,
There's no, actually, so for my kids, it's all electronic. So they actually have, there's a saving system they have, where they have basically a debit card. And I have an app on my phone where I can, give them an allowance, pay them for chores, whatever they might be doing, and they can spend their money that way on electronically. Like they don't even, honestly, it's so weird. When I gave my kids, giving them cash, they literally don't know what to do with it. It's funny. My daughter got $50 from mom for her birthday, or grandma, and it's still sitting on her dresser. Like she doesn't even know what to do with $50. She goes, "Oh, well, $50, but like, where is it? It's not useful to me." She only thinks of her credit card as useful.
It's interesting. It really is an interesting phenomenon. And I'm just wondering if the fact that everything is digital, does that give them less of a reality of money where it's not physical and tangible?
Yeah, I think so. I mean, there are people who would advocate these experiments where for a week or a month, pay for everything in cash only. Like, because then you have the experience of it being reduced. You can see actually, it's not a swipe of a card and a signature, where you're not even really looking. Instead, there's something, it's more real world and less abstract, I guess.
Yeah, you're right. I think that if everything is abstract on your phone, it becomes like magical. It encourages magical thinking.
It does.
You can
Well,
somebody can add digits to your phone, but it's harder to add an actual pile of silver coins. But
Yes.
changes.
Yeah. I agree. I think it is. It does make it really abstract. And I see it when kids. It does make it harder to teach them about that and help them understand about how you accumulate capital. I mean, they try, but it is because it's abstract. I think it does make it harder with the inflation stuff. I think one of the big question is inflation. Are we going to? The world is going through a very difficult time period now. Where, as you think we're in the Greater Depression, just entering the tail end of the hurricane here, where things are going to get worse. In that environment, the big question is, and I think it's a legitimate question: do we experience deflation or inflation? Because in a depression, capital is destroyed. That's one of the right. So that we would think then that in the fractional reserve banking system, there's a good argument for why asset prices where money could be destroyed. So if inflation is just expansion of the money supply and deflation is contraction of the money supply, um, if that's the way you define them, then it seems like you could experience deflation pretty easily, couldn't you?
Yeah, you could actually. And right now, I think everybody from the central bankers on down wants to see more inflation because let's admit it, we've had some generally pretty damn good times for many years. And it's been an inflationary environment. So, hey, laissez les bon temps rouler for more time. I mean, let's just keep it up. Okay. Well, I can understand that point of view. And if you have a deflation, it means that, there's a lot of bonds that are going to go to zero, and the holders of those bonds, including pension funds, are going to have nothing. And a lot of stocks, a lot of indebted companies will go to zero because they can't pay their bonds, and the stocks become worthless. And a lot of shareholders are going to be unhappy, and a lot of employees for those dysfunctional companies are going to be unemployed and so forth. So yeah, nobody wants to see it come to an end, but it will, because the problem with debt, among other things, is that it ties you down. When you have a huge debt, you don't have any flexibility because paying off that debt limits what you can do and where you can go. And, you really become a bit of a slave to the debt. I've got to do things to make that. So yeah, you're enslaved by your debt. And why is that? Debt is a sign that you've been living above your means, just as savings is a sign that you're living below your means. Savings gives you flexibility and freedom to act. Debt, hey, it's great. If somebody lent me $1 million today, I could live really high off the hog for the next year until I frittered it all away. But then I got to pay it back with interest. So it's going to be even worse. I mean, it'll be, mortgage for the rest of my life or however long, paying it off. So that's the problem. Debt is a fool's paradise.
Well, isn't the term mortgage? I think that the word mortgage, doesn't it come from some French word? It's like death debt or something like that.
Yeah, mort. We could look that up, but the French word for death is mort, M-O-R-T. So
Yeah.
it could be that's exactly the same root word. Yeah.
I think it is. I think I read a long time ago somewhere. It was like something like debt until death, or debt for life, kind of a situation. And it was, which when you think of it in those terms, it doesn't seem like a financial instrument anymore. It feels like you actually get a sense of what the real obligation of it is. Like, do you really want a 30-year mortgage on your home? I mean, is that?
Well, as long as the house is going up, you can buy a bigger house and make more money when you flip it to somebody.
Exactly.
So, yeah, hey, that sounds like a pretty good idea to me. Everybody's, I think real estate only goes up, although in many cities around the country today, they're finding that's not the case. But I guess the question that everybody is asking themselves is, are we going to have more inflation or are we going to have a deflation? And I think the only way we're going to get a deflation is that it's going to be catastrophic and accidental, where there are so many bank failures, so many insurance company failures, so many pension funds that are underwater, that the government can't, or the Fed can't print up money fast enough to bail them all out and kiss it and make it better. In that case, the whole house of cards, which is, let's say, 100 stories high, comes crashing down. And it really would be financial chaos for a while. Lots of unemployed people. Turns out they're working at uneconomic jobs, so forth. So if we have a deflation, it's only because the government failed to fight it hard enough by printing up trillions and trillions. I wonder if they'll ever get to quadrillions. And I'm sure that Biden's going to have to ask his science advisor what comes after a quadrillion. They might find out. So chances are we're going to have a lot more inflation. That's what Biden has promised. I mean, sure, he's a liar, but he's not lying about this. I mean, the first step is 3.4 trillion more dollars. So more inflation is coming, and they'll build the house of cards higher.
So in a normal world, if the economy weren't so manipulated, a deflation outcome from this would be expected, right? Because they'd just be like, but because the Fed seems so proactive at this point, it seems like they learned a lot in 2008. It was like a dry run for this, where they just were setting up proactively all these different lending facilities, all these different, totally in violation of the Federal Reserve Act, but just setting these things up to be able to make sure that whoever needed money could get access to it to keep the financial system from collapsing.
Yes, and having artificially low interest rates are an important part of this picture, because let's say the federal government's official debt, and this isn't accounting for contingent liabilities and insurance programs they're backing and Social Security they got to pay in the future, and I'm not counting that. I'm just talking about official debt. It's crowding $30 trillion now. So supposing interest rates, to reflect inflation and the riskiness of the economy today, suppose they went back to 10%. Quite possible, because people have forgotten that back in the early 80s, the federal government was paying up to 18% for money. Let's say it just goes to 10% today. So that's $3 trillion a year in interest alone, which is to say interest alone would equal just about all the other government spending put together. I mean, it fluctuates so wildly.
Yeah.
But they can't afford to pay that kind of interest. Where they've got to print up as much money as they spend on everything else just to pay interest. It would get completely out of control. So they got to keep interest rates low, and they got to keep printing money. They painted themselves into a corner. If I was in Uruguay right now, you might recall the pictures I've got on the wall in back of the place. I've got a picture by Bedard. One's the failure of communism, which is two ducks in a bedroom that have painted themselves into a corner with red paint. And the other one, the failure of capitalism, the same two ducks are sitting on a huge pile of currency, watching the sun, which looks like a dollar bill, sink into the sunset. So, it's we're heading towards dystopia. But listen, we've been living way above our means because of all that debt. That's what debt means. But it's even worse than that, because all of the money that the government exports, I mean, since about 1980, the U.S. has been in import-export deficit. We've imported a lot more than we've exported. Well, how can you do that? Well, in the real world, you can't. But if everybody accepts your dollars, then the Japanese give us Toyotas, and the Germans give us Mercedes, and the Colombians give us Coke, and we just give them dollars. That's a great trade. You get real stuff in exchange for paper money.
Right.
But, so that has been a tremendous support under the standard of living of the average American. All this good stuff coming into the country in exchange for dollars at zero cost, in addition to the borrowing and so forth. So it makes me pretty gloomy, because the piper is going to be paid. These foreigners don't have to hold on to US dollars, and they won't in the future. They'll be hot potatoes. And what's going to happen to all those US dollars? Well, if let's say if the Chinese have a trillion of them, and nobody else really wants those dollars because they're hot potatoes at that point, they're going to come back to the US in exchange for the title to land and companies and Boeings and all kinds of stuff. So now the real wealth goes out and the paper money comes back, and inflation will super explode in the US. But
Mm.
this is complicated because most of the central bank, all the central banks in the world, their major asset is dollars, which would turn into toilet paper. I mean, this is, I really think we're not just sitting on a time bomb. We're sitting on a time bomb with a time bomb where it's going to be an H bomb that goes off, not just some
Mm.
TNT.
Mm. Well, so the probability of deflation in your mind is low, simply because the central bank has demonstrated that they will do whatever it takes to make sure that these the cascading consequences of insolvencies that would cause deflation cannot occur.
Absolutely. They can't let deflation occur. But there will be deflation in certain areas of the economy because as people get deeper in debt and don't have any savings to rely on, they're going to stop eating filet mignon and start buying more rice and beans. So what happens? There's a deflation in the price of cattle because people can't afford to eat beef anymore. And actually, the price of rice and beans goes up because there's more demand on them. So that's like this is one of the distortions that inflation causes, where at first people are eating more beef and less rice and beans. And then after a while it gets up, it reverses. So you get these crazy fluctuations in price, which is if you're good enough and you can see far enough ahead, yeah, a speculator can take real advantage of that.
The other thing,
Every
just
person isn't a good speculator, so he gets hurt, not helped.
I was just thinking if deflation if stopping deflation essentially is limited to the areas where the central bank can create facilities, where it can provide capital, provide money, not capital, provide dollars essentially to those companies to keep insolvencies from happening. You would think that there would basically be for most Main Street businesses who just simply don't have access to that capital like that. That in like the real economy, you would experience a lot of in the non-financialized world, outside of the big corporations, essentially, those deflationary effects would be running pretty serious because you're going to have insolvencies and restaurants and bankruptcies and all of those things in the Main Street economy that they are happening. And the Fed cannot really account for those. I mean, the Fed can only really help on the, with on the publicly traded companies, right? Or the regulated entities.
Yeah, that's basically right. The Fed can only help big companies. The government likes to work with big companies. And yeah, so the little guy gets squeezed as usual, doesn't he?
Yeah. It's like you experience, so you end up, as a little guy, you experience both, potentially localized deflation, where like small businesses dry up, so jobs go away. So these little cycles on Main Street, but then inflation in the financialized economy.
Yeah, but the Fed throws them a few table scraps. I mean, they give people, $1,000 or something. They're like, here, kid,
Right.
take this. Meanwhile, meanwhile, the big companies that are paying their top executives 50 and $100 million bonuses, no joke.
Yep.
I mean, they're the ones that get the big bailout money. It's
Right.
just absolutely perverse. You'd think that if the average person understood this, that there would be pitchforks and lit torches in the streets, but that's not going to happen. Everybody's on Prozac and Zoloft and 100 other things, so they're too zombified to, first of all, find out what's happening and then be outraged. It's it's a gloomy scenario. I'm sorry
Yeah.
it's amusing, but it's gloomy. I can
Yeah.
be
It does feel like we're in the age of compliance. People are just they we just go along. We just go along with what we're told.
Absolutely. And when I go outside, if I walk outside right now, I promise you there are going to be all kinds of people out here in the middle of the countryside where I am wearing their masks, walking by themselves.
Yeah,
I mean,
it's crazy.
this is Einstein was so correct when he said after hydrogen, the most common thing in the universe is stupidity.
Stupidity. Yep. So one last question, I guess. So if so, uh, you're convinced if you had to go one way or another, it's definitely inflation versus deflation, simply because of what the Fed will do.
Yeah.
And and I think we saw this in 2008, where I was shocked by what they were willing to do, and
Yeah.
they've just upped the ante and proactively in 100 ways this time. So that
Up
seems
the
to be
ante.
true.
This inflation or deflation argument has been going on that I remember in my life since the 60s.
Hmm.
I remember listening to debates between guys. And of course, the inflationists were right then and they're right now. They're, shocks along the way where you go, oh, are they going to pull it out? But yes, they always do. And they've shown that they have no alternative but to print more money. So the ultimate disaster is going to be just catastrophic. It can't go on forever.
So if you're betting that that's what happens, and the way you sort of you can protect yourself is from some of the things we talked about before with buying real money, gold, right, or speculating in gold mining stocks, things like that.
I'm sorry to just have a single tune to sing at this point, but the only thing that's cheap in the world today, by many, many parameters of what constitutes cheap, is commodities, but in particular, for lots of reasons, gold and also silver, and also the stocks of the companies that mine them, and a few other commodities, that mining companies. And I can't wait to sell all that crap and buy Berkshire Hathaway, but not now.
No, definitely not. Definitely not. Well, good. Well, hopefully that settles some of the people's understanding of the inflation, deflation, and why uh, I've almost fallen victim to this deflation argument many times, just thinking, well, assuming that the market was actually a real market and it could function, it was functioning normally, but we're so far beyond that. It's obvious it can only go one way.
Yeah, that's right. Anything's possible. Could have a deflation. I mean, you can make up a scenario where, yeah, that could happen, but very unlikely at this point, I think.
Yeah, I think so too. All right. We'll leave it at that. Thank you very much.
Thanks, Matt.